Hello and welcome to Amagi, co-hosted by myself, Nima of economicsjunkie.com, and Dylan Moore of the Volitional Science Network, which you can find on YouTube. We are here to tackle ideas both ancient and modern in an effort to bring you the tools needed to expand the power of your worldview, making you a more potent entity professionally, politically, philosophically, or otherwise. We are graciously being hosted by the Think Liberty Network, which you can find at think-liberty.com. And this is episode 6, and we're going to be talking about investments and something that's very dear to me, Harry Browne's so-called permanent portfolio, which is an investment portfolio that allows you to diversify your savings in a manner that leaves you very unexposed to any sort of risk in the different financial equity, etc. markets out there. And it is pretty neutral to market outcomes because it allows you to benefit from booms, such as the one we have right now, and inflation and depression and recession. So at any given point, any of these four phases is sort of more dominant given the current economic situation. And the portfolio is aligned so that you can reap the benefits from the assets that benefit from the current situation. And I also want to talk about the causality as to what causes the different assets in this portfolio to move up and down on a more macro, sort of maybe macro/philosophical level, so that people maybe have a little better of an understanding of why stocks and bonds and gold, etc., move in one direction or the other any given day or week. And this portfolio performs at about 9% per year on average, if you backtest it for several decades, 50 plus years, which is pretty astonishing given that it's so that its volatility is incredibly low. It's lower than most, if not all, strategies that are comparable that I've sort of looked through. And 9%, that's also the average stock market gain per year if you go back for decades. However, with the stock market, you have way more volatility. At any given point in time, you can't really feel safe about your stock market exposure, because what if you need the money tomorrow and you're in a depression or a big crash? Then that 9% average doesn't really mean much. But with this portfolio, the one that Harry Browne devised in his book Fail-Safe Investing, you have very low volatility. So at any given point in time, if markets turn sour or whatever, you always have other assets in the portfolio to pick up the slack and then some, not just balance out the losses from your losing assets, but also produce some pretty sizable gains. And the four assets are stocks, long-term government bonds, cash, and gold. And
can I jump in real quick, Nima?
Of course.
Sure. So you'll notice that I've been very quiet so far, and that might be the case
what's up with
because this is all new information to me as well. Nima's definitely the expert here, and I am hoping to learn just as much as you guys listening to it. So essentially, Nima's really going to have the reins here, and I'm just going to poke questions when I don't understand or I need a little more emphasis on a certain idea. So with that, go ahead, Nima.
Yeah, so the way the strategy works is that, actually zooming out a little more, the way Harry Browne talks about investing. And when we say investing, we don't necessarily mean investing in the way that economics textbooks say it, but rather we mean how to allocate your savings, just to be clear. But the way Harry Browne talks about investing is that you should have a permanent portfolio and you should have a variable portfolio, okay? The permanent portfolio should be your safe haven, should be your nest egg, the money that you need for the future, for a down payment or for retirement, etc. So that's sort of money that you don't want to speculate with. And everyone needs to figure out for themselves how much that is. Harry Browne recommends a strategy or thought experiment, I guess is more accurate, where he just says, okay, you just sit back and you think of all the money you've put aside, and you imagine, okay, what if I had $1,000 less than that? And if that's okay, then you can just keep going until you hit an amount where, okay, that money I really need and I can't gamble with. And then the other money that you can gamble with, you can put in a variable portfolio where you can invest in, risky stocks or cryptocurrency or whatever it is that you want to invest, which, like for example, I've invested in cryptocurrency, and I also have some speculative stocks. But so today we're not talking about the variable portfolio. We're talking about the permanent portfolio, which is a portion of your savings that you don't want to play games with. And like I said, you basically take that amount that you don't want to gamble with, you split it 4 ways, 25% each: stocks, bonds, cash, and gold. And then over time, the allocation, the percentage of each asset is going to change, obviously. If you have a stock market boom, then your stock market percentage is going to go up quite a bit. And if any asset exceeds 35% of the total portfolio composition or drops below 15%, then you need to rebalance your portfolio. That means you sell the gaining assets and buy up the lagging assets. And as a pleasant side effect, this also causes you to buy low and sell high, but on a strategic level, without fretting over, okay, where's stocks going tomorrow? Where's gold going? Will Peter Schiff finally get his $10,000 gold? You don't need that. You don't need to worry about short-term speculation. You benefit from gold gains when it's time for gold to rally, and you sell off some of it if it outweighs the other asset in the portfolio significantly. And so you kind of end up selling high, buying low without really even trying, without trying to time the market. So let's start talking about the individual assets in the portfolio.
Quick question for you, Nima.
Sure.
What is your personal comfort level for splitting this secure side of your investment versus your volatile side of your investment?
Personally, I am sort of 50-50. So,
and go ahead.
Yeah, about 50% of my net worth is in the permanent portfolio. 50% is in speculative assets. I'm not saying by any means that that's what other people should be doing. It's an individual choice that everyone has to, figure out on their own, basically.
Well, because you said that the way, a way that I forgot his name already. The guy who wrote this book,
Harry Browne. Yeah,
Harry Browne recommended is to just imagine your own savings account and just start walking backwards until you're no longer comfortable. And usually someone's going to have their own specific reason why they aren't comfortable past that number. Yeah. What was your comfort indicator where you said, okay, I can't go past that number because X?
Just, honestly, it's kind of emotional. There's no...
Yeah, what were your emotions? It's definitely emotional. I'm wondering what your emotions...
It's like, I don't feel comfortable with less than that. I just imagine myself having less in the safe compartment, more in the risky, and I just don't feel comfortable. It's a feeling of comfort, I think, and feeling that you're prepared for what's coming down the road. Retirement, future bills, taxes. Maybe you don't always have employment, So it's more an emotional than a rational choice, I think.
Cool.
If that helps.
No, I think that does help, because I think a lot of people, when I've been guilty of this, when they approach investing or savings, or where to park something safely, or how to do something volatile, they think it's a rational decision,
right?
And it's really not. I mean, you got to use your reason to figure out what's going on, but at the end of the day, you have to satisfy your emotions. And I think this is why most people lose in volatile markets, is because when something's rallying and let's just go with gold. Actually, let's go with Bitcoin because it's more volatile. When Bitcoin's going up, everyone's getting excited and they buy. And then when Bitcoin goes down, everyone freaks out and they sell. Well, that's literally the opposite of what you're supposed to do. Buy high and sell low, right?
Right.
And it's because their emotions got caught up with it. And in order to do something volatile, you really have to step back and say, okay, what are my emotions doing? And I really have to keep track of the emotions, because my reason component is going to come up with it, whatever reason it needs to satisfy my emotions.
Yeah. So when you have a big picture strategy, it's kind of funny because you end up making the right choices without trying to time the market. You know, if my speculative portfolio...
That was very interesting.
Yeah.
I did catch that.
If my speculative portfolio is too large because Bitcoin has gone up so much, you know, then I'll sell some and allocate them to the permanent portfolio, because just because I don't feel safe with the majority of my net worth being exposed to a speculative asset like that. So in my experience, I've found that I end up buying low and selling high without trying, just because I have the proper strategy in place.
Yeah, your strategy seems to build in a natural balancing effect. Because if you're going to say, okay, I'm going to split it 50-50, and that's the way it's going to be. Well, if Bitcoin goes, doubles, and suddenly your portfolio is 60-40, where you got 60 in the volatile and 40 in the secure, and you go, oh, I got to get this back to 50-50. Well, when you sell the Bitcoin, you just sold it high, and when you're buying the secured, you're buying it low. And the same thing with what you just described within the secured, where you've got your stocks, your cash, your bonds, and your gold. If one of these shoots up, and you say, okay, it's 35 and the rest are 20, I think that math works out. No, it doesn't. But whatever. If it shoots up 35 and the rest are 20, and you sell it off to go back down to 25%, and you buy everything else, well, you just sold it high and you bought everything else low.
Exactly. And
fascinating.
You know, what's interesting is because if people only look at stocks in isolation, they tend to misunderstand what overvalued versus undervalued means, because you can only speak of overvalued and undervalued if you have a comprehensive picture of all the other big alternatives that are out there for investing. And the permanent portfolio just perfectly covers pretty much the biggest assets, other than real estate, which, is Harry Browne considers more of a speculative asset. But all the sort of safe assets that are out there, the permanent portfolio covers. So when one moves up in relation to the others, then you have a much better understanding of, what's overvalued, what's undervalued. And
fascinating.
You don't, like when I first started the permanent portfolio in 2015, which was the stock markets were high and everyone was like, stocks are going to crash anytime now and gold is going to go crazy and all this stuff. And bonds are going to crash because they only pay 3%. So during that time, the stocks have performed phenomenally because you just never know. You never know. People think they know, but they don't. And with a permanent portfolio, you basically admit you don't know. And that's the beauty of it, because then you benefit while everyone else, keeps on telling you, no, it won't last, it's going to crash, put it all in gold, get out of stocks. Well, it doesn't matter to me because, I have my gold. I feel well with my gold allocation. I feel safe with my gold allocation. And if something happens, then I'm covered. So,
well, and then if something crashes, that's the time to buy it.
Right.
Right? So, I mean, to flip it around, let's say, you got your four things, your cash, your stocks, your bonds, your gold. If the stocks crash down to 15%, theoretically, you would sell some of the other stuff and buy the stocks because, and again, you just sold high on the other stuff and bought low on the stocks.
Exactly.
Right?
So let's talk a little bit about the individual components of this portfolio. So as I said, the first component, stocks. Okay, stocks are claims to future corporate profits, discounted by the risk-free rate. The risk-free rate
Oh, God. We're already confused.
Yeah, the risk-free rate is, of course, the rate that is offered by the Federal Reserve Bank, offered and manipulated upwards by the Federal Reserve Bank to, whatever it is. At the moment, it's 2.25 or 2% or something like that.
And these are the bonds. These are essentially the bond rate, right?
No, I was just talking about stocks. I'm just saying stocks, the corporate profits are discounted by the risk-free rate. So that gives you sort of an idea of how stocks are priced. And so they do well. Generally, they do well when corporate profit expectations are high and or move up. When corporate profit expectations for the future, like for the next 2, 3, 5, 10 years, become higher than expected, that's when stock prices go up. And they also do well when the risk-free rates unexpectedly goes down. If the Fed were to declare tomorrow, we're going to start lowering the interest rate by 25 basis points every quarter, that would result in a huge stock market boom, all else being equal. Because the current expectation is that the rate will keep going up and up till around 3%. And, nobody knows, but when it's another recession, then they're going to start lowering the rate again.
Can we talk about the cause and effect between those two things? Because we had a private conversation about this the other day, and I've heard you mention this over and over and again in the past. I had no idea what you're talking about, and it finally clicked to me the other day. And it requires some understanding about MMT to understand why this connection is the way it is. And by the way, Nima didn't mention this at the beginning. We do intend, because we've been doing podcasts about modern money theory and what this means kind of in a political aggregate. We kind of want to talk about modern monetary theory now in terms of what this means for you and me personally. How do you and I interact in the system now that we understand a little better how the system actually operates? So when you're talking about the discount rate against stocks, what exactly does that mean?
Yeah, so when market investors evaluate or try to price the value of a stock, they take all the future expected profits from that per stock, and they calculate the present value of those future cash flows. And the present value of a future cash flow is calculated by what's called discounting it. And you discount it by the risk-free alternative. So currently, if I want to invest money for 1 year in a treasury bond, for example, a treasury bill, actually it's 1 year, and it pays me 2%, then I know, okay, if I put $100,000 in treasury bills, then I'm going to get a $2,000 plus by the end of the period. So if someone tells me, hey, I have a venture for you to invest in, and it's going to return, so you give me 100,000, and it's going to return, you're going to get 100,000 plus $2,000, so same amount back at the end of that period, then it's not really worth investing in it. Then I might as well just go for the risk-free alternative. So you take
because with his idea, you could lose all the money. He might screw it up or steal it or do whatever else. Whereas with the treasury bills, because we understand MMT, we know it's risk-free. The government can never not afford to pay those bills.
Right.
They're just marking up numbers in bank accounts. And treasury bill versus cash is very similar to the difference between a checking account and a savings account. One just has a little bit different interest from the other. So when you're going and buying treasury bills, you're switching your cash to another U.S. security, which is called a treasury bill, which happens to pay a certain percentage rate. Like you said, it's like 2% right now, which is risk-free, which means anything else that offers that 2% interest rate or lower isn't worth your time, because why would you invest in something at 2% that involves risk when you have the option to do 2% when it doesn't involve risk?
Yeah. So if there's a business venture that tells me, okay, there's going to be $100,000 profit in a year, then I'll what's that worth to me today? The 100,000. I would have to take 100,000 divided by 1.02 if the current risk-free rate for a year is 2%. So $100,000 in the future is worth like 98,000 or something close to it in the present. So that's sort of, and then if there's a cash flow, if there's another 100,000 in 2 years, then I would have to discount that by the cumulative risk-free. So 100,000 divided by 1.02 times 1.02 or 1.02 squared. Yeah. So that's basically the concept of discounting cash flows.
Let me unpack that, because we just talked about exponential math without even writing it on a chalkboard. So when you're talking about the discount rate, where you're saying, okay, $1,000 in a year is worth like 998 right now. What you mean by that is to say, if I had $1,000 and I sat on it for a year, and a year later I still had $1,000, when instead of I could have put that money into treasury bonds, which are risk-free, and had $1,020. If we calculate that backwards, that 2%, we would have to divide $1,000 by 1.02, because that's how the algebra works out. If you set the equation up, you divide by 1.02, which is to say, if I hold my $1,000 and wait for it to, and just hold it and have it not change, the amount of money I lost out on was that 2% interest rate that was risk-free.
Yeah.
Because that's an investment I could always lean on, where I know I can't lose my money.
Yeah.
I got that right?
So future money is worth less than present money. And the way we calculate it is by discounting that cash flow. And that's basically how the value of any profit generating investment in the present is, or how the future cash flows of such an investment should be calculated. Anyone who took finance classes or whatever would have gone through that stuff.
And this is kind of what the Federal Reserve is controlling, right?
Yes.
When they're bumping up and down the interest rates, this is what it means to you personally.
Exactly. If the rates,
or one of the things,
if the rates go up unexpectedly, then stock prices will fall, which is something, or rather, if the expectations of future rates go up unexpectedly, then stocks would tend to fall, all else being equal, which is kind of what happened in March of this year. I think February or March. There was, the schedule of Federal Reserve hikes was slightly shifted forward, so that then, changed the expectations. Long-term rates went up, stocks went down. Profit expectations hadn't changed much.
Now, let me unpack that too, if you don't mind. That was dense. So you're saying that we've got a certain expectation of what the Federal Reserve is going to do with its rates. For example, it's going to go up 25, what do they call it, basis points, which is 0.25%. It's going to go up 0.25% every half year. Let's say that's what the Federal Reserve announced. And then, like you said, what was it, in February?
Yes, I think it was around February. Yeah, I think it was February. Around
February, it went. The rates actually went up before they had previously announced that it was going to go up. So this was the shock, because everyone had planned on, okay, they're going to go up later, so I'm going to make these investment decisions, and all of a sudden, bam, they went up.
Well, the rates didn't go up per se. The expectations of future rates went up based on some statement that the Fed made, based on speeches, and then we could see from the behavior of the betting market that's just that's what happened.
Got it. And then to connect back to stocks, what we were saying before, because we were simply talking about a volatile investment option. The stocks are that volatile investment option, right? Where if the expectation that the rates are going to go up means that there's more there's potentially more availability for risk-free money. Well, if the risk-free expectations, say, were to go up to 3%, what that means is any stock that's not performing at least 3% isn't worth your time. So people are going to naturally move their money from these lower performing stocks to the higher performing risk-free rate, which is why if the expectations of the rates go up, the stock market goes down because people are moving their money from the stocks to the risk-free rates. And I assume vice versa would happen
all
as well.
else being equal. So
right.
Profit expectations don't change.
All else being equal, right.
And interest rate expectations move up. Then the present value of the individual corporation's future cash flow falls, and thus the stock price goes down. That's sort of the causality. So that's the other big component. Of course, corporate profits are the other big component in stock prices. So, for example, right now you're seeing, rate expectations are going up, but stocks are still going up just because the profit expectations are outpacing the risk-free rate. And also, we haven't yet talked about what's the source of corporate profits. How can I get a sense of where corporate profits are going? And there's an equation that's called the Kalecki equation, which is something I came across through MMT. I think Kalecki was actually a friend of Minsky's, who was a pretty famous economist. And Kalecki says that this equation, which is an identity, but it also explains causal factors. The equation says that the source of aggregate corporate profits in any economy. So let's take the U.S. economy. The source of all aggregate corporate profits is investment spending plus the government's budget deficit plus the current account surplus plus the...
And that's between foreign nations.
Yeah.
The current account surplus.
Between us. So if we export more than we import, that tends to... That's net plus on aggregate corporate profits. And then finally, also if capitalists consume out of profit, that also adds to aggregate corporate profits itself.
That's to say if capitalists take their own profits and use that to invest in more
buy,
capital.
Just to consume. Yeah, because investment is another component already covered. But even if capitalists consume out of their own profits, then it adds to aggregate corporate profits. Not to their own, obviously, but to aggregate corporate profits. Yeah.
To somebody's.
So, and so the way that in the permanent portfolio, when you buy stocks, you just buy an index fund that represents your entire stock market. Index funds are great because they're cheap. There's a big sort of shift going on in the investment community. More and more people are investing in index funds, which, by the way, also outperform actively managed funds. And so you can get, in the US, for example, you can get funds like the ticker ITOT or VTI or the SCHB or at something like 0.03%, at a fee of around 0.03% at this point. So that's a very incredibly low fee. For other funds, you pay like 0.5.
Wow.
Some funds even charge 1% or so because they think their active managers are so great, I guess. Pay themselves a lot.
That's great.
0.03%.
Holy
shit. You pay for the ITOT.
That's like a Bitcoin fee.
So... so for the stock portion, you don't buy individual stocks or anything. You don't speculate. You just buy the entire stock market, and that's thousands of stocks. So even if one company underperforms or goes out of business, it doesn't really hurt you much because it is so incredibly diversified. And these funds do very well in a boom. Like right now, they've gone up maybe 20-30% this year alone, I think. But that's for the stock market portion. So stocks do well when corporate profits do well, which, as we described, corporate profits do well when we have large government deficits plus investment spending plus export surplus plus consumption out of profits. So,
woo!
That's it for stocks.
So let me jump in there just so we can tie that up. So one thing to understand from all that stuff about corporate profits, I guess in terms of your own investing, it's not super important that you understand everything that goes into a corporate profit, but just to know that there's this complicated thing called corporate profits that can also affect stock prices, similarly to whatever the
well, yeah, I mean, that's really the active driver of stock price, because that's what a company does. It has to generate profits. So that's really...
Whereas the interest rates are kind of this floor that moves up and down.
Thing that companies can't control, really. And, as long as the expectations, if rates go up in the future, but that's expected, then it doesn't really make a big difference because market investors have already priced it all in, etc. What you always want to look at is for changes to expectations, because that usually can cause pretty big moves. Mm-hmm. So, like, for example, if we're looking at the Kalecki equation, we want to make it practical. So I just said that aggregate corporate profits, a big component that is the government's budget deficit. If the government if suddenly we were to come out and say tomorrow that, okay, we're now going to balance our budget. This is the new objective. We've spent beyond our means, blah, 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 all this talk. And we're going to
nonsense
we're now going to balance the budget. I can almost guarantee you that will cause a big crash in the stock market, because that would screw with people's future profit expectations and reduce corporate profits. Stocks would move down accordingly. So that's for stocks. The next asset is bonds. Okay, and the way I buy bonds in the permanent portfolio, the way Harry Browne recommends it, is that you buy the longest term government bonds that are available. These bonds...
And what's that term, 30 years?
Currently it's 30 years. That's the longest one you can get in the US. They've even talked about introducing 50 years to 100 years bonds at one point, but currently it's 30 years. Some countries, like I believe Australia and the UK, they have 40-year bonds. Japan, I think, has 50-year bonds, maybe even longer, because all their other bonds are negative or zero. So, yeah, whatever the longest government bond in your currency area is, you want to buy that. In the Eurozone, it's a little complicated, but that would be the German government bonds, because they're really the ones that are considered the safest assets. So you want to buy these bonds because they are not because you're so excited about the 3.2% that they currently pay you, even though it's not bad actually, for a risk-free investment. But you buy them as a hedge for when stocks crash, because when stocks crash, then that's because profit expectations are down. When profit expectations are down, then we enter a recession. And when we enter a recession, the Federal Reserve will at one point will start cutting rates. That's just how they behave. Investors know that. And so when the Federal Reserve starts cutting rates, long-term bonds will probably be the best performing, or one of the best performing assets you can hold. Because that means that when you buy a 30-year bond right now, you lock in a rate of 3.2%. What that means is essentially that the market is betting that when they buy this long-term bond, they are better off than buying all the individual short-term bonds that are available in that period. So let's say there's 30 one-year bonds, and the one-year bonds, if you take the cumulative...
And this is over the span of that 30 years,
you take the cumulative average of your expectations of what the Federal Reserve's short-term policy will be, essentially. Because the Fed always declares a new interest every quarter. So if you don't want to buy a 30-year bond, then that's because you think that you're better off having your money in a short-term asset, like a 3-month treasury bill, and you'll just always roll it over. At the end of the 30-year period, you think that you will have done better by just reinvesting and rolling over. Whereas if you buy a long-term bond, currently at 3.2%, but let's say in the short term, suddenly the Fed, for whatever reason, starts cutting rates aggressively to this coming quarter, and then just keep cutting over the next 30 years, the rates stay below 1% or at 0.5 or whatever percent. That means that your bet, that generating an income stream that nobody else can generate anymore, percentage-wise, based on how much you put in. And the value of your bond...
Had you bought... That's the case had you bought the 30-year bond,
if you bought the 30-year bond at 3.2, okay. In the meantime, suddenly interest rates turn out to be much lower within that 30-year period, all the cumulative average interest rate ends up being lower than you thought, then your bond value will go up, you know. So if current market expectations of future rates go down, then your 30-year bond will move up, and move up aggressively, actually. You could have a crisis in some crises, like in the 2008 crash, I think they moved up something like 50 to 100% or something like that, you know. So, or, you know.
And can they move down?
They will move down if the interest rates, if the short-term interest rates move up more than expected. So, for example, you know, I bought a lot of bonds at 3%, and now the bonds pay 3.2%. That means the value of the bond has gone down since then. And at the same time, however, it doesn't really matter because my stocks have performed phenomenally. So when your bonds don't do so well, you know, it's usually when your stocks or other assets will compensate, and then some. So that's really it about bonds. Like, what really all there is to bonds to understand is a long-term government bond is a bet on the behavior of short-term rates. And
so do you recommend going for the long-term bonds or the short-term bonds?
I don't necessarily recommend anything because I'm not an advisor. What I do is...
What do you do? You're not a financial advisor. What do you do with your own stuff?
There are 4 different assets. So this one, we're just talking about long-term bonds. So there's another component that is short-term, which we'll get to. But for this component, the bonds, you just... what I do is I buy long-term government bonds. And then also, you know, there's no corporate bonds in this. You don't buy any corporate bonds in this portfolio strategy. And actually, there are investment advisors like Cullen Roche on pragcap.com. He says that there's really no point in buying corporate bonds. Corporate bonds are really just like stocks in drag, because corporate bonds are, you know, they give you fixed income, yet you're still exposed to company risk. In a deflation, in a depression, the corporate bonds won't give you the hedge you need in your portfolio. They will drastically underperform the government bonds. And that's exactly the point why you have them. You want them to compensate for stock market losses. So bonds are really a bet on the Federal Reserve's interest rate policy, and particularly a bet that their rates will be lower over the period than expected. So that's what happens when you have a depression or recession. The rates go low. And that's when you benefit from having long-term bonds. You know, if the rate on 3%, if the rate were to go down from 3% to 1.5% on a long-term bond, the value of your bond will go up something like 70, 80%, you know, 80, 100, whatever percent. So these assets will rally quite a bit and provide the gains that you need in a balanced portfolio. So that's basically, and of course, you know, for what MMT teaches us, and as Dylan pointed out, we understand that there's no default risk in a sovereign government. So that's why you want to have these bonds in your portfolio, because, you know, you eliminate default risk. Whereas with stocks, you don't, you have some sort of default risk. Companies can go under, etc. With the long-term bonds, you don't have those. So that's that for long-term bonds. Then the next asset that I want to talk about is gold. 25% of the perm portfolio goes into gold. And when we say gold, we mean a physical gold that you purchase at a gold coin dealer and lock away in a safe deposit box or in a safe, or bury in your garden, or, you know, deep dive, ocean deep dive, bury it somewhere there, or whatever. Any other ideas, Dylan, where you can bury gold? I don't know, but
no, the ocean deep dive was pretty good.
Yeah, exactly. You can be a pirate. Why not?
Hide it in a cave in the mountains.
Yeah, that's an excellent one. Like build an underground tunnel system and hide your gold there. So personally, I like, you know, a combination between a bank safe deposit box and some in my own safe at home. But definitely not. It's not really a good idea to buy gold certificates, in my opinion. It's just my opinion, because gold certificates don't give you the actual. They don't give you access to the actual gold, and when things get desperate, when markets crash, or we have a depression or civil war, whatever disaster, that's when you need gold, and that's when you want to have direct access to gold and not some certificate that lets you bet on the gains of the gold price. So gold does really well when real interest rates are low. And real interest rates means basically the risk-free rate that the central bank sets minus inflation. And you see here that if inflation is high, gold does well. But really, that's not sufficient alone. You have to have real rates that are low. So if you have a high inflation, but you have very high interest rates, then gold won't necessarily do very well. Like in the 1980, 1981, 82, gold began crashing from 800 and only settled at one point like a level of 200. So
is that because when the interest rates are so high, let's say they're up at like 6% or something, that 6% essentially risk-free money.
Exactly.
So people's money go towards these well-paying bonds as opposed to getting dumped into gold.
Yeah, I think that's what I speculate too is the reason, because gold and cash or cash equivalents, they are very they're safe haven assets, they're liquidity assets. So you definitely, if cash pays a lot of interest, then people who hold gold have one more incentive to move their money out of gold into cash.
Which, can I add this point, is one of the arguments, anachronistic arguments that we make for bonds in the first place, going back to the MMT conversation, getting a little, back to the, macroeconomic view at this, is that potentially one of the original reasons that we have bonds in the first place was to keep people from getting their gold from the government.
Yeah, good point. Yeah, exactly.
So if that, that really emphasizes why high bond rates would drop the price of gold.
Yes.
Cool. Carry on.
And so that's basically gold. Gold as well. And, my view on gold is kind of, we also touched on a little bit in our recent episode. I think gold is kind of like it's not used as money or whatever, in the way that Austrians say and the way that gold standard proponents say. It's not used as money, but it could be. I think that's the thing about gold. If all else fails, if governments break down, if trust breaks down, then gold can and actually has in the past served as a wealth allocation medium or medium of exchange to an extent, but only in those scenarios. So that doesn't mean that right now it has no value. It only means that right now the value is commensurate to the likelihood of that kind of full-on civil war crash scenario. So if that likelihood rises, then the value of gold goes up. So it's kind of like a little bit like an insurance, if that makes sense.
Mm-hmm.
So the gold is the ultimate fallback. If all else fails, if all other systems fail, then, and also what Graeber discusses in Debt, the first 5,000 years, one of the important characteristics of gold is that it can be stolen. That's why it does well in times of universal warfare, because you can just take someone's gold and melt it, and nobody will ask you where it came from. There's no accounting entry. There's no... what do they say in the gangster movies when someone wants to have a bunch of dollars? They say, "Give me so and so much in
untracked,
non-consecutive dollar bills." Like almost any other means of payment or exchange is somewhat always traceable by a third party, but gold isn't.
Well, and then also with gold, if you have an individual government that loses a war or crashes or goes hyperinflative like Venezuela or something, you never have that problem with the value of gold because it's kind of all the governments have always been competing for it at once.
Yeah.
It's not like there's the trust of one government surviving, giving it its value.
Right. So, and Robert,
I got a question for you about gold.
Yeah.
And I guess this applies to silver as well. What do you do about broker fees when you're buying and selling your gold?
Yeah. So
is there a way to minimize that impact? Because in my experience, they're nasty.
They're around 2 to 3% is what you should expect.
Okay.
So
if you're paying more than that, go somewhere else.
Yeah. You should not pay more than 2 to 3%. And when you sell your gold to any coin dealer, you should expect them to take it at about 1% above the current spot price. So at the end of the day,
that's good information.
Yeah, you're really only paying like 1 to 2% at the end of the day. So don't go to the pawn shop where they take, give us your gold and we take 20% off or something like that. But any reputable coin dealer, they will pay you about 1% above spot price for your gold. Yeah. So that's a cost, because if you buy gold index certificates on the stock market, you don't have that, obviously. But that's the price you pay for having this pretty shiny metal holding in your hand, actually. And one more thing I want to say about gold, which is just my random thought of mine, comparing gold to crypto. Okay, because a lot of people say Bitcoin is digital gold, which I kind of agree with. In a sense, I guess it can act like that. However, there's really something that gold offers that crypto will never be able to offer, and that is it's an asset that stands by itself and on its own. It's a chemical compound that doesn't...
Physical thing.
It's a physical thing that doesn't depend on external systems. With Bitcoin, you still have the outside blockchain and the mining mechanism.
Need a computer access.
Yeah. I mean, you can store your Bitcoins physically on a piece of paper as well. So technically, you don't have to have it. But yeah, definitely Bitcoin depends.
That's rough. That's impractical to the extreme.
Well, for your large Bitcoin savings, that's totally what a lot of people do and what you should do and what I do too. So you have it on paper. But then when you need to spend them, you move them out of paper, put them in a hardware wallet or something like that. But I just think that's important to point out that, gold, I think, will always be around, will always be this asset that doesn't depend on any external systems, whereas Bitcoin and other cryptos, they always kind of do.
Question for you. What about silver? Would you say this, like, silver's an equal option to gold, or gold is better than silver?
As far as the permanent portfolio strategy goes, silver, if you backtrack, it doesn't do as well as gold for your portfolio.
I wonder if one of the reasons is that silver is much more used in industry.
Yes, silver. You can kind of look at silver as a hybrid between gold and copper in a sense, because silver can do well when gold does well. Doesn't always have to. There can be times when gold performs really well and silver doesn't, and vice versa. Yeah, silver will do well during demand-driven commodity booms, which are basically industry driven usually, because silver is a lot more used.
If suddenly we develop a new industry, or some certain industry is doing well that actually literally uses silver in chemicals, silver nitrate or whatever. I mean, that's what photographers used to use. Yeah. That could really drive the price up, and then suddenly that business goes out of fashion or whatever, and then you plummet.
Much more volatility in silver. So definitely, I mean, I have, maybe a small amount that you can consider your change. I hold in silver, maybe like, $1,000 or whatever. But not the large majority of your gold allocation. It should really be gold. And Harry Browne, by the way, he did phenomenally well in silver. And he says, no, don't put silver in your permanent portfolio. But he did great because the silver price at the time was fixed, and he speculated on. He had a really successful speculation back then.
You're not criticizing investing in silver. Right. You're just saying it's not a good option for your permanent portfolio. Yes.
The permanent portfolio is a whole. You have to look at it as a whole. All these assets work together. And, because another thing I always hear from people is, but I don't want to buy long-term bonds. Can I just make this portfolio without the bonds? Well, no, you can't, because then it's not the permanent portfolio, and then it won't give you the return that...
Right, because the bonds are affecting the stocks, and they're affecting the gold and vice versa.
Yeah.
Well, nothing's affecting the bonds, I'm sorry, except the decision that the Fed's making.
Actually, none of these assets. Well, another interesting aspect about the permanent portfolio is actually that there's almost a perfect zero correlation between all these assets. They don't really have any positive or negative correlation. They just respond to economic conditions, which is very rare in portfolio construction, from what I understand. Usually, portfolios are always about, well, this asset reacts opposite to that asset, so we have it as a hedge. But in the permanent portfolio, from what I understand, there's actually no strong correlation between any of these assets. They do their thing based on the economic situation. So that's That's about silver. So that was gold. And then the last one is what is called cash. But by cash, what is really meant is, just short-term treasury bills, which is 1 year or less, or just a money market mutual fund that only invests in treasury bills.
So are we calling it cash because it's so easy to convert back into cash?
Yes, it's basically cash equivalent. You can actually, if you have a money market mutual fund that only invests in treasuries, you can write checks against it. It's like cash, basically.
Okay.
But I find the treasury bills are really the best alternative for your cash, or the best cash equivalent, because they pay higher interest rates than any savings account offers. And there's no FDIC limit. There's no risk if you have large amounts that you're investing or whatever. There's no such thing as a bank risk where you need the FDIC to make you whole in the end. And for that reason, you can also put in a savings account. I guess if it's smaller amounts, it makes sense, because treasury bills, you buy $1,000 minimum. So I'm just saying, it's something like that. It's any short-term savings, and the best version, in my opinion, is treasury bills or a mutual fund that invests only in treasury securities. The reason why I say only in treasury securities, because there are other money market funds that invest in commercial paper and more risky assets.
Which defeats the purpose of the permanent portfolio.
Right, which are sort of privately backed. And there was a time in the 2008-2007 crisis where some of these money market mutual funds that are always supposed to be worth $1 per share. Nobody's ever questioned that. They're like money. You can write checks against them. However, there was a time during that crisis when some of these funds broke the buck, is what it's called, and went below $1, like 99 cents, 98 cents per share, which is not supposed to happen. But it happened because some of those assets weren't as safe as people thought they were. But with treasury securities, you always know that the government can create the money and they can't go bankrupt. So in a sovereign government.
So why have 25% as cash at all? If I could have gotten a better interest rate by buying the long-term treasury bills.
Bonds. Long-term treasury bonds.
Bonds. I'm sorry. Long-term treasury bonds. Why don't I just slide all my cash over to there and have 50% in long-term treasuries, 25% in gold, and 25% in stocks?
Well, because the long-term bonds are not always going to do well. There are times when the short-term bonds do better than the long-term bonds. For example, if there's a boom and rates keep going up and up and up, long-term bonds will do pretty bad, but your short-term cash will actually do pretty good. At one point, I think before the 2007-2008 crisis, you would get like 6% or 7% on your savings account. But you only hear about these things when it's too late. But with a permanent portfolio, you're always in that. You're already there, and you're already reaping the benefit. And in combination, sort of symbiotically, they all work together very well. Like, for example, Harry Browne says that long-term bonds don't do well in a recession, which I don't necessarily agree with, because I've looked around and they tend to do pretty well in a recession, actually. So he said that you buy them for deflation, depression. But actually, they do pretty well in a recession, too, in my experience. However, in a recession, what you also have, a recession usually happens after a boom. And during a boom, the Fed keeps hiking rates up and up and up. So during the recession, for a year at least, you're still going to enjoy pretty good rates on your cash. So cash is a pretty good asset during a recession. It's something that's just there for you in case you need it, It's not just, not necessarily investment strategy wise.
I was going to say it's the most liquid of the four, right?
So you always want to have a liquid asset. So that's also where you take out. If at one point you start withdrawing, you start making regular withdrawals of, something like 4% or whatever every year, or you do monthly withdrawals that add up to that, then you can take them out of your cash account. And that's a pretty good way of making withdrawals without having to pay capital gains taxes. Because all the other assets, when you're selling them, you have to.
That's what I wanted to ask you next.
Yeah.
So, actually, before I ask you that, did you finish what you wanted to talk about with cash?
I think we've covered it all regarding cash. Yeah, that's the fourth asset, short-term treasury bonds.
So let's talk about taxes. Again, normally on this show, we've been talking about kind of the aggregate effective taxes. Let's talk about us personally having to pay these damn taxes. Yeah. How are the taxes different between these four categories?
So on stocks, you pay taxes, but pretty low taxes, actually. It's probably some of the lowest tax you pay on compared to all other incomes on dividends, right? And I think that's like a 15% tax or something like that.
Because it's considered passive.
Yeah, and on stocks, you also pay if you sell your stocks. You pay capital gains tax, which is also pretty preferable in this country, at least in the U.S.
Is that if you hold it for a year, or that doesn't matter?
If you hold it for a year or longer, then your capital gains tax is a little lower. In this country, at least. Got it. Then if you sell it short term, yeah. And so, but the other thing is, if you buy like one of these if you buy one of these big funds like the Vanguard Total Stock Market Index, which is the VTI, or the ITOT, which is the iShares one, the dividend is actually relatively low. It's maybe like 1.7% or so, which is what you want to go for. You want to have a stock allocation that pays rather low dividends, because dividends are the worst in terms of tax. I mean, in terms of tax treatment, in terms of when you hold stocks, you want to avoid dividends, because dividends, they just you have to pay even if you reinvest the dividends. You owe tax on the dividend that was paid out to you. Versus if the company just keeps the money, then they pay they pay corporate profit tax once. But that's it. But if they pay out dividends, then it's double taxation.
And your value in the stock isn't the dividend; it's just the fact that the value went up.
Yes. So exactly. So that's for stocks. So the stocks you should hold outside. You shouldn't have them in a tax deferred account like an IRA, or at least I don't, because that's where you can put the bonds, and that's where you get to next. So the long-term government bonds probably hit you hardest in terms of taxes, because the interest on those bonds is usually higher than any dividend payments and cash interest. And also gold has no yield at all that it pays out, so there's no issue there. But the long-term bonds, they pay you annual or quarterly interest, and that is also taxable. And interest payments, I think you pay a little higher tax than on dividends, from what I understand. But that's why I put, as much as I can, I put the government bonds in my IRA, and that way.
Do you have a Roth or a traditional?
Well, I have a traditional. With a Roth, I don't really know much about it, but it's also, you have to have a certain income to qualify for. I mean, you can't be above a certain income to qualify for a Roth, I think.
You can't be above. I didn't know about that one. You can't be above a certain income to qualify for a Roth IRA.
Yeah, I think so. I mean, I've looked into that a while ago, but in any case, I mean, with the you want to have a tax deferred account where the interest accumulates and you reinvest the interest in that asset, and you don't pay taxes on it. That's how you get the maximum tax bang for the buck.
Let me make sure I understood that correctly. So you're saying if we've got long-term Treasury bills,
bonds,
I guess short-term, it doesn't matter, and we get interest on it, if I take that interest and I reinvest it into Treasury bills, bonds, damn it, sorry, and I reinvest that into Treasury bonds, I don't pay taxes on that?
Well, you don't if you have it in a tax-deferred account. If you have it in your IRA.
Oh, I see what you're saying. Yeah. Got it.
Yeah, so that's why the long-term bonds should be in a tax-deferred account if you can. The gold, there's really no point in holding it in a tax-deferred account because there's no interest on it. And actually, if you sell the gold, stocks or gold in your IRA, then pay yourself out, then you pay your income tax on the payout, and so you actually pay more than you would have paid had you kept it out of the tax-deferred account.
Well, then don't you have to pay early prepayment penalty for taking your... Or are you talking about after you're 65?
Yeah, after you're whatever, ready to take out.
Oh, okay,
yeah.
Got it.
So, but also I'm not a tax advisor, so let's be clear on that. But
look up all this on your own. This is just stuff that we've bumped into.
This is what I do, So basically the bonds and the cash are the biggest candidates to put in your tax-deferred account. I would say the bonds are probably the best because your cash... kind of defeats the point of having cash to put it in your tax-deferred retirement account because your cash you won't have readily accessible. And so those are the four assets that make up the permanent portfolio. And together, back-tested, etc., the portfolio generates about 9% per year at a very low volatility. So that's very safe. And that's why I do my investments this way.
That's totally cool.
Yeah.
Like I told you guys at the beginning, this is... I'm learning all this stuff as he's talking away. We've chatted about it off recording before, but this is still all new to me. And it's totally fascinating that it's possible to set up something like that where, whether or not it's actually hitting 9%, there's kind of... You're creating this system where these natural checks are in play, as you mentioned, where you're automatically buying low and selling high, regardless of whatever the market's doing.
Exactly. Regardless of...
way cool.
Whether we have a serious boom or a serious crash or depression or inflation or people are worried about North Korea sending some nukes in. Then we have other problems, I guess. But still, your portfolio will take care of you. And that's what you want from a portfolio, that you allocate your safe, your nest egg towards, or your the money that you don't want to gamble with. And unless there's any further questions from Dylan, this has been
no.
Okay. Oh, happy.
Yeah. There isn't. Sorry, go ahead.
This has been Amagi, co-hosted by myself, Nima of economicsjunkie.com, and Dylan Moore of the Volitional Science Network, which you can find on YouTube. And if you have any questions, please contact us, send us comments, check out the show notes, and we will see you next time.